Alright, we got liquidity today. That's the next video, boys. We're learning about liquidity today, what it is, how to see it, how to use it, and it's gonna give you another component, another step in the process to understand what the fuck you're looking at on the charts. I know you look at a chart and you still have no idea what you're looking at. It just looks like a bunch of green and red sticks. Well, now you know it's candles. Now you know it's candles. Green and red candles on your chart, and you're starting to understand a little more. But this is the next step in understanding fully. So we're going to talk about liquidity. Lock in, take some notes, take some pictures, understand what liquidity is. This is the next step. See you guys. Let's get straight into it. Also, boys, I'm a little sick. I know I sound sick. I'm going to sound sick. Just deal with it. We'll get better soon. We got to hit Sauna in the steam room tomorrow. So, yeah. Other than that, lock in. Time for liquidity. All right, so here we're looking at a chart on NQ, which is the NASDAQ. Now, before I get into finding liquidity on a chart, I want to explain how liquidity works, what it is, and everything about it. So I want you guys to think of liquidity like fuel. And I want you guys to think of how a car works. Obviously, you need fuel for a car to work. It's the same thing with the market. The market needs fuel. The market needs cash. It needs money in order to continue moving. And liquidity has resting orders, meaning there's money sitting at liquidity. Points of liquidity is points where there are resting orders or there's resting money at these points. Now, liquidity is best seen as, and I know I explained this before for highs and lows, liquidity is seen as points where there is a magnet. Think of a magnet pulling something, right? Let's say you have a straight line and there's a magnet in the middle. What's going to happen? It's going to dump you down like this to the point where the magnet is attracting whatever this object is. The middle goes down to where the magnet is. The same thing with liquidity. Like if you look at a chart here, you look at the points where it's obviously being pulled one way or another. Like right here, liquidity, 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 liquidity. It's, in simpler terms, you can view it by seeing wicks. Wicks, remember how we talked about candlesticks and there's a body and then there's the wicks, the spaghetti looking noodle things. That is liquidity. Liquidity are the wicks on these candles. Now, there's liquidity in every single time frame. And remember how I said it's kind of like a car? The same way a car needs fuel to operate, the market needs liquidity to operate. So the market is always going to grab liquidity before making a move. Whether it's in the shorter time frame or the higher time frame, you're going to grab liquidity before moving higher or lower. It doesn't matter where you're going. Now, what I want you guys to understand about liquidity as well is that the higher the time frame, meaning like let's say you're on the 1 minute and then you jump to the 1 hour, the wicks on the 1 hour or the liquidity on the 1 hour are way stronger than the wicks on the 1 minute, because that means there's more data compiled for that one candle, meaning there's more liquidity, there's more orders, there's more money sitting at this point. Now, okay, you understand how liquidity works now. How do you use liquidity? Liquidity can be seen as one, points of reversal, or if you move through a point of liquidity and you don't start reversing, you're going to continue moving strongly in that direction, right? So think of it as a point of possible reversal. I like to view it as a point where you could have it. It's like basketball. You have a jump ball in basketball and two people are fighting for the ball. It's the same thing with liquidity. Whoever grabs that ball has the upper hand, is dominating at that moment. So let's say you're at a point of a reversal and you start getting indications of reversing. Now that person has liquidity, it has fuel, it can keep going where it wants to go. Now if the other side takes it instead of the reversal, you see the continuation, they have the upper hand, because if they take the liquidity or the fuel that's right there and they just continue going down, that means there's way more of, in this case, sellers. There's way more sellers in this case to continue going lower. Now, when you guys find liquidity on a chart, just think of it as there's money resting at these points. Now, you can use this to your advantage by using them as two things. One, as a target to take a trade off liquidity, seeing that you, let's say you reverse, like right here. We have a point of liquidity, and we reverse, and let's say you get your setup here. You're like, oh, okay, I'm using it as a confluence to my advantage to take a short position because I see everything else that I want to take this trade. Plus, we grabbed liquidity, meaning we grabbed fuel, meaning we can continue going lower, right? And the market always moves from internal range liquidity to external range liquidity. And this is something I'll cover on the next video with fair value gaps. But in this case, external range liquidity, or ERL, is liquidity, right? So the market always is going to seek out either ERL or IRL. ERL is external range liquidity, and internal range liquidity is the fair value gap, which we'll go over next video. And you can come back to this video to understand it a little better. But in this case, you can use liquidity as a point to take a trade. Let's say you see everything else you want in a setup for a reversal, and we just took liquidity from here, meaning we took the fuel, we took the money. Now we can continue going lower. So you can take your short off here for the reversal. Now the next thing that you could do with liquidity is use it as a TP, or a price target, a target price, right? Let's say you're in the short and you're like, oh, okay, I don't know what time to get out of this trade. When could I see that my trade is like, okay, maybe max potential? Where can I get out at a safe zone but get the maximum out of this trade? What do you look for? Liquidity. Why? Because it's a point of possible reversal. Like right here, you see liquidity down here, you see liquidity right here, and you see liquidity right here. So when you're in the short, you can say, okay, I'm going to target this point of liquidity because it's the closest level that we are most probable to hit. And it does hit there, and it continues going lower and lower and lower, but that's something that you learn with experience. So you can use liquidity as two things. One, a confluence to take a trade, and two, as a TP, where you place the exit of your position, where you're going to leave the position. Let's say for some reason you want to long at this point that we are right now, and you're like, okay, where can I target to get out of the trade? You're going to target liquidity. That's the liquidity right there, because we're probably going to go to this level. I know it's a little confusing, but liquidity is fuel. You view liquidity as fuel. The market needs liquidity to continue moving one way or another, so it's always attracted to liquidity. You're always going to go to a point of liquidity, whether you use it for taking a trade or for exiting a trade. Liquidity is always a point that we go to in the market. So yeah, now you guys understand that liquidity just means there's resting orders. It's like a monster, a dormant monster waiting to be activated. At liquidity, where there's liquidity, there's a monster sleeping there. As soon as you get to that point, okay, shit, monster's awake. Now he's ready to get going. Just understand that there's resting orders at points of liquidity, meaning someone got exited out of a trade, meaning their stop loss was at this point of liquidity. So once you get there, the resting order is now being able to get used. And the reason why this is important is because banks put their orders in large amounts. I don't know if you guys understand how orders work in the market, but let's say you wanted to enter a trade for, here, let me move this out of the way. Let's say you wanted to enter a trade for this price. Let's say 20,500. Let's say it's what you wanted to enter the trade at this price. And there was only 144 orders available at this price. Now, think of a bank. A bank moves in millions, if not billions, of dollars, right? So you can already kind of see where I'm going with this. If there's 144 orders and the bank wants to purchase or sell at this underlying price, they can't fill all their orders right here because there's only 144 of them. They need more. They need more, right? So what's the next thing? They're going to look for the next price being 2501. And then at 2501, maybe there's 180 orders, 184 orders. And so on. There might be more orders there, but liquidity is important because if there's more resting orders in one place, the banks are attracted to this level, because this could be like a normal level on the market, like a normal price, right? Now, if we go to a point of liquidity, which maybe is 506, and we look at 506, right? And let's say at 506, instead of being 184 orders, there's 588 orders. If the banks want to get filled for everything under one average, like it's like saying you're going to buy something, but you have to buy it at a bunch of different prices. You'd rather buy everything at one price and just average everything to one. So let's say you bought here at 506, being a bank. You're able to fill more orders here. So the banks are attracted to the places where there's more resting orders, also known as points of liquidity. So when we go to a point of liquidity, it means banks can get more orders filled for the same price, which means if the bank is entering, you should probably enter too. We want to trade with the banks, not against the banks. They're the ones that are moving the markets. They're the ones who have the amount of money to be able to move the market as much as they do, because retail traders can't really move the market. It's banks. So in the fact that you're trading with the banks, you want to be in a place or a position in a trade where the banks could be entering as well, because if they can enter where there's more resting orders, you should want to do the same. That's as simple as it gets. Liquidity is where the banks are attracted to, where the banks could trade off of, and where you want to get in as well. You want to trade with the banks, not against the banks. So again, two things. Use liquidity as a point of entry, a confluence for entry, and two, use liquidity as a point of exit, meaning your TP. That is liquidity in the most simple terms possible for you guys. All right, you guys should be able to find this on your own. As I already explained, liquidity is literally just points where it looks like a magnet is pulling price one way. But, let's go on the 4 hour real quick, and let's just map out some points of liquidity so you guys can see how I do it and how you can do it as well. It's going to take a second. So let's say right here, boom, 1 point. Here, another point. Here, another. I'm not going to do every single point, but you can start seeing what liquidity looks like. It's literally just points where it's not following the regular chart. Like, it's just points that are being pulled away. It's like a outlier, you could say. Look at this. So much liquidity everywhere. And you can start seeing as you look at what I've already marked out, you can start seeing how price reacts to liquidity as either a reversal or a continuation, and you see that at these points of liquidity is where you find explosive moves. There's just liquidity everywhere. But yeah, guys, you guys should be able to find liquidity on your own after seeing me mapping it out right here and explaining how it looks. Other than that, there's really nothing much to say besides what I have already told you guys about liquidity. Now, that's all I have for today's episode. That's liquidity on today's episode. So yeah, if you guys fuck with these videos and you want to keep learning more about trading, how I trade, how to use the concepts that I use as well in your day-to-day trading, and to learn to trade how I trade, just make sure to keep following with the series. It's the EA Trading Bootcamp. Drop a like, comment what you guys want to see on the next videos, and make sure to subscribe. And lastly, if you want to keep up with my day-to-day trading, I have all my socials linked down below, the TikTok and the Instagram. It's the same handle. It's official EA Trading. And I'll probably be posting more on my main Instagram as well. I'll link that as well. It's Aquiles.Erminy. Yeah, I'll see you guys on the next video. Like I said, I'll be uploading at least one video a week. I'll try to get more out, if not, but at least one video every single week until I can teach you guys how to trade. Peace.